Your alarm doesn't go off. You wake up before it, the way you have for 6 years now, because your body learned a long time ago that the market doesn't care if you slept. It's 5:12 a.m., you're 35, and somewhere in a custodial account you'll check before you brushed your teeth, there's $500 million sitting under your name, or more precisely, under your control. Not yours. You didn't inherit it. You didn't found the company that made it. You run it. That distinction is going to matter more than you think by the time you finish your coffee. The coffee itself is nothing special. A pour-over beans a guy named Theo sources for you because he used to work at a roastery in Portland and now works for you, technically, though his title on paper says Estate Operations. You drink it standing at the counter in a t-shirt that's older than your marriage, and for exactly 11 minutes, you are just a person in a kitchen. Then the phone lights up. Not a text, a number. Overnight, the portfolio moved 0.4%. That sounds small until you do the arithmetic standing barefoot on cold tile. 0.4% of $500 million is $2 million. It happened while you were asleep. It'll happen again tomorrow, in either direction, and there's nothing you did last night to cause it, and nothing you can do this morning to stop the next one. You get in the car. Not a Ferrari, not even close, because you learned early that the car people expect a person like you to drive is the car that gets you noticed for the wrong reasons, and notice is expensive in ways that never show up on a balance sheet. It's a black SUV, 3 years old, plates that mean nothing to anyone. You drive 11 minutes to an office suite on the 4th floor of a building with no sign on the door. Just a number, 402. That's it. That's the whole marker for $500 million of decision-making happening behind it. Inside, 4 people are already at their desks, and it's not even 7-0. A woman named Odalise handles tax structuring and has been on with an accountant in Zurich since 6 a.m. because that's when it's daytime there. A guy named Priest runs manager due diligence, which means his entire job is finding out if the hedge fund you're about to wire $11 million to is actually good or just good at sounding good. There's a compliance officer whose name you still sometimes forget because he was hired 4 months ago after the last one burned out. And there's your chief investment officer, a woman twice your age named Renata, who has managed money since before you could drive, and who you pay more than you pay yourself, on purpose, because replacing her would cost you more than her salary ever could. By 7:40, you've already made 2 decisions that will matter more than anything you'll do for the rest of the day. The first, whether to increase exposure to a private credit fund that's returning 11% but locks up your capital for 5 years. The second, whether to sign off on a $40 million wire to a real estate developer in Austin who needs the money by Friday or the deal falls apart. Nobody explains these to you slowly. Nobody waits. You have 40 minutes, a stack of numbers, and a room full of people whose entire job is to make you decide faster than you're comfortable deciding. Here's what nobody tells you about the number itself, about $500 million, before you're the one holding it. It doesn't feel like money, not the way your first paycheck felt like money, not the way $340 in a checking account with rent due in 9 days feels like money, urgent and physical and real. $500 million is an abstraction that occasionally becomes very, very real, usually at the worst possible moment, like when a market drops 6% in a single session and you watch $30 million evaporate on a screen before your second coffee is even cold. You don't lose sleep over spending decisions anymore. You lose sleep over decisions that move 8 figures on a Tuesday because someone in Zurich made a phone call you didn't hear about until it was already done. So what does it actually mean to run this? Not own it, run it. It means you are the person standing between a family's entire multi-generational fortune and the 100 ways it could quietly bleed out through bad tax structuring, an overconfident manager, a lawsuit nobody saw coming, or simple boring inertia. It means the people who work for you are smarter than you in every specific domain, and your entire value is knowing which of them to listen to and when. It means before most people have checked their first email, you've already made calls that will ripple through a family's finances for the next decade. Who actually works for you? What decisions get made before lunch? What this money is actually doing while you sleep, while you drive, while you drink a coffee that costs less than the shoes on your feet. That's what the rest of this is going to show you. Because the fantasy stops at the alarm clock, what happens in the 4 hours after it is where the job actually lives. Room 402 doesn't have a name on the door because it doesn't need one. This is a family office. And the entire point of a family office is that almost nobody outside of it should know it exists. Not a bank. Not a wealth management firm with a logo and a lobby and a guy in a blazer who calls you by your first name because a CRM told him to. A family office is a private company built to do one thing, manage the financial life of a single family the way a Fortune 500 company manages a business, except the business is a person's entire net worth, and the shareholders are people who show up at Thanksgiving. Banks sell products. That's the distinction you understood within your first month on this job and never forgot. A bank has an incentive to put you into the fund that pays the bank the best fee, not the fund that performs the best for you. A family office has no such conflict, because the office only exists to serve the money it's managing. There's no upsell, there's no quota. When Renata recommends against a fund, it's not because she's protecting a relationship with the fund manager. It's because she ran the numbers at 5 a.m. and the numbers didn't hold up. Families with real money learned this decades ago, and once you cross a certain threshold, usually somewhere north of $100 million, the math starts to favor building your own team over renting someone else's. So who is the team? Renata, your CIO, sits at the top of the investment side, and her entire job is asset allocation, meaning the decision of how much of the $500 million sits in which bucket, and why. Below her, analysts model returns on deals that haven't closed yet. Priest does manager due diligence, which sounds boring until you realize his job is the difference between wiring $11 million to a hedge fund that quietly blows up in 18 months and one that doesn't. Odalys and a rotating bench of outside tax attorneys handle structuring, because at this size, taxes aren't something you file once a year, they're something you architect continuously, moving assets between trusts and entities so the family keeps more of what it makes without ever doing anything remotely illegal, just extremely well planned. Then there are the estate planners, the ones who think in decades, not quarters, because the actual client here isn't just the person alive today. It's the grandchildren who haven't been born yet. Here's the number that matters more than any of their titles. Roughly 60% of that $500 million doesn't sit in anything you'd recognize from a Robinhood app. Private equity stakes in companies you'll never see a headline about. Real estate, not the house you live in, but industrial warehouses in 3 states and a stake in a logistics park outside Phoenix. Public markets, stocks and bonds, make up maybe a quarter of it, the most liquid, most boring, most necessary slice, because someone has to be able to write a check on a Tuesday without unwinding a 5-year lockup to do it. The rest sits in alternatives, venture funds, private credit, sometimes a stake in a sports franchise or a wine collection that's really just a tax play wearing a hobby's clothes. You didn't design this allocation. You inherited a philosophy and you refine it, quarter by quarter. The same way a ship's captain doesn't build a ship, he just decides which way to point it. None of this happens on a whim, and that's the part nobody outside the room understands. There's an investment committee, and you sit on it, but you don't run it alone. Every position above a certain size gets voted on. Every manager gets a risk limit, a ceiling on how much of the portfolio they're allowed to touch, because the fastest way to lose a fortune isn't one bad decision, it's one bad decision made at full size with no guardrail stopping it. Reporting happens on cycles, weekly snapshots, monthly deep dives, a full quarterly review where every single number gets defended out loud in a room because the family, even if they never look at a single spreadsheet themselves, has the right to ask you why. And if you can't answer why, you don't keep the job. This is where the real tension of the seat lives, and it's the one distinction that took you the longest to actually feel in your gut. There's a difference between preserving wealth and growing it aggressively, and every single meeting in that office is secretly a negotiation between the two. A family that made its money 3 generations ago wants you playing defense, wants volatility low, wants the number to still be there for people who haven't been born yet. A family sitting on money made in the last 10 years, still close to the founder who built it, wants growth, wants you swinging, wants the number to double before the kids are old enough to spend it. Read the family wrong, and you'll either bore them into firing you or scare them into firing you. Renata taught you that lesson before you'd been in the seat 6 months. Now, the benchmark, the thing you should actually sit with for a second. You're 35 and you're not managing your own $500 million. Almost nobody your age is. What actually gets you into that chair by 35 usually looks like this. Either you're 3rd or 4th generation, handed a seat your grandfather's success built, learning the machine because the machine is now your inheritance, whether you wanted the job or not. Or you spent your 20s inside private equity or a hedge fund, grinding 80-hour weeks nobody saw, until a family with a fortune and no internal talent decided they'd rather pay you $400,000 a year to protect it than pay a bank 3 times that, in fees to underperform it. If any of this is starting to reframe how you think about money you'll never personally hold, that instinct is exactly why the book exists. It walks through the entire architecture, the entities, the allocations, the governance, most people never see, and this week it's discounted, links in the description if you want the full map instead of the tour. Because managing the machine and living inside the pressure it creates are two very different things. And that pressure is where we're headed next. Renata warned you about this in your first week, and you didn't believe her until you lived it. The hardest part of the job was never the spreadsheets. It's the 11 people who all think the $500 million belongs to them personally, and none of them are entirely wrong. You report to a family, not a person, and that distinction breaks people who've never sat in the room for it. The patriarch wants the fund preserved exactly as it sits, untouched, a monument to what he built. His daughter, 41 and running 3 companies of her own, wants capital deployed aggressively into deals she's championing, because she's convinced she can double it before her father's even gone. His grandson, 24 and 3 semesters into a business degree he'll never finish, wants a distribution now, this quarter, for a startup he swears is the one. You owe all 3 of them the same fiduciary duty at the same time, and there is no version of any given Tuesday where satisfying one of them doesn't disappoint the other 2. You learn fast that the job isn't picking the right investment. The job is picking the investment you can defend to 3 people who want opposite outcomes and still sleep that night. Concentration risk is the one that keeps Renata up, and after your first close call, it keeps you up too. A family that made its fortune from a single logistics company still, emotionally, wants to hold that stock, that legacy, that name on the building. You watch a different office, one priest used to work at, lose almost 30% of a $380 million fund in under 2 years because nobody had the spine to tell the founder's widow that keeping 40% of the family's total net worth in one airline stock wasn't loyalty, it was exposure. The stock didn't crash because of some scandal. It just did what concentrated positions do eventually. It corrected. And there was no diversification underneath it to catch the fall. Bad advisors cost you differently, quieter, slower, and somehow worse. You inherit a manager relationship from the previous CIO, a guy who's been running a $12 million sleeve in private credit for 6 years, always hitting his benchmark, always showing up to the quarterly review in a blazer that costs more than your first car. Nobody questions him because nobody's questioned him in 6 years. Then Priest pulls the underlying loan tapes on a slow Thursday out of pure boredom and finds the fund's been marking illiquid positions at cost instead of fair value for 18 months, which means the return you've been reporting to the family isn't real. It's a number built on a number nobody's checked. You unwind the position over 4 months and the real return comes in at 40% less than what was on paper. Nobody committed a crime. Everyone just trusted the last guy's trust in the guy before him. That's how 6 years of quiet erosion happens without anyone raising a hand. Then there's the version of the threat that never shows up on a balance sheet at all, and it's the one that scares Renata more than any market correction. Succession. You watch a $500 million dry up into 3 separate lawsuits over 11 months at a different family office 2 floors down, not because the investments failed, but because the founder died without a properly updated estate plan, and his second wife and his kids from his first marriage spent more on litigation than most people make in a lifetime, fighting over control of a trust structure that was ambiguous by accident, not by design. The money didn't lose value, the family lost the money to itself. You start to understand that the actual job, the one nobody puts on the org chart, is making sure the people related to each other by blood don't destroy in a courtroom what took 2 generations to build in a boardroom. And lifestyle creep, the quiet one, the one that never announces itself with a lawsuit or a crashed stock, just shows up as a slightly bigger number every quarter that nobody wants to be the one to flag. The family's monthly draw for private jet time, home renovations, a 4th property in Aspen nobody's visited in 14 months, it climbs 8% a year while the fund's real return sits closer to 6%. You do the math on a Tuesday morning that nobody asked you to do, and you realize if the spending curve keeps outpacing the growth curve, the $500 million isn't a fortress. It's an hourglass with sand you can't see moving. If any of this is making your stomach do the thing mine did the first time I mapped it out, that's exactly the gap the book fills. It's not theory, it's the actual anatomy of how families lose 7- and 8-figure fortunes to exactly these 4 things: concentration, bad advisors, succession chaos, and lifestyle creep, and how the offices that survive 3 generations build structure specifically to prevent it. It's discounted this week only, links in the description, and if you're the kind of person still watching at this point in the video, it's probably worth the read. Because here's what it actually feels like to live inside that gap, on a Wednesday afternoon in October, when Odalise walks into your office without knocking, which she never does, and closes the door, which she also never does. The credit manager, the blazer guy, the one whose loan tapes Priest pulled, he's on the phone wanting an answer on a redemption by end of day, threatening a gate on the fund if the family pulls now, which would freeze $11 million for another 18 months minimum. You have 4 hours. Renata's in London and won't land before the market closes. The patriarch wants it pulled immediately, no discussion, protect the principal. The daughter wants it held, convinced the mark-to-market correction is temporary and a forced exit at the bottom locks in a loss that recovers itself if you just wait. You're the one sitting in the chair with the phone in your hand, and whichever way you move, someone in that family is going to be furious with you by dinner, and $11 million is going to end up either frozen or gone, and there's no version of the next 4 hours where you get to consult a textbook. You pull the loan tapes back up on your second monitor, you call Priest, you call the fund's outside counsel, and you make the decision knowing full well that in 6 months, whichever way this breaks, somebody at that Thanksgiving table is going to bring it up. That's the seat, not the plane, not the Casio versus the Cartier. This, a phone in your hand, a clock running down, and a family watching to see if the person they trusted with everything actually deserved it. You tell people you run a $500 million family office and watch their face do the math in real time. They picture the jet, the calendar with more white space than work, the version of you that spends Tuesday afternoons deciding between the Aspen House and the one in Jackson Hole. Nobody pictures you at your desk at 7:40 p.m., still in yesterday's shirt, cross-referencing a Form 990 PF filing deadline against a grandson's demand letter because he thinks the foundation owes him a board seat he hasn't earned. That's the part the outside world never budgets for. The glamour is the costume. The actual coat underneath is scrutiny, isolation, and a phone that never fully turns off. You find out fast that isolation isn't a side effect of the job, it's baked into the seat itself. You can't complain to friends outside the industry, because the second you say the number out loud, the conversation stops being a conversation and starts being a performance. You can't fully vent to the family either, because you work for them, and venting reads as disloyalty even when it's just exhaustion. Renata is the only person who understands the specific weight of it, and she's in London half the time. You start keeping a running list in your phone of things you can't say to anyone, not because they're scandalous, just because there's no one positioned to hear them without it changing how they see you. That's the loneliness nobody mentions when they picture the job. Not sad lonely, structurally lonely. Built into the org chart. Then there's the myth about your calendar, the one where running $500 million means your day is mostly spent deciding what to buy. You track your actual hours for 1 month, just out of curiosity, the way Priest tracks everything, and the breakdown embarrasses you a little. Compliance and reporting eat close to 30% of your week, filings, audits, the quarterly package that goes to all 11 family members, whether they read it or not. Meetings eat another 35%, and not glamorous meetings, 3-hour sessions about whether the Dynasty Trust's funding schedule still aligns with the estate plan drafted 6 years ago under different tax law. Family diplomacy, the actual art of keeping the patriarch, the daughter, and the grandson from declaring war on each other over a wire transfer, eats another chunk you didn't even have a category for until you started counting. What's left over, the sliver where you're actually allocating capital, deciding what the family buys or sells, is maybe 15% of your time. You spend more hours reading legal documents than you spend spending money. Nobody puts that on a recruiting brochure. The mindset shift is the part that actually changes you, though, more than the hours ever could. You stop thinking in quarters and start thinking in decades, sometimes in generations that haven't been born yet. Renata has you sit in on a meeting about a trust structure designed to release principal to beneficiaries only after they turn 35, staggered over 20 years, specifically so a kid who isn't born yet can't blow through 8 figures at 22 the way his uncle did in the 90s. You're not managing money for a person anymore. You're managing money for a family tree, half of which is hypothetical. That reframes everything. The $340 bread and the $2,140 sneakers you used to think about on the farm, the stuff that felt like the whole story of wealth, starts looking almost quaint next to what you're actually doing, which is building systems designed to survive people who will never know your name. You're not buying anything for yourself. You're pouring concrete for a building you'll never live in. That's the lesson underneath all of it, the one that took you longer than it should have to actually believe. Managing $500 million was never a fantasy job. It's a disciplined job wearing a fantasy job's clothes. The people who last in this seat aren't the ones who love the number, they're the ones who can sit through a 4-hour compliance meeting about UBTI exposure in a private equity sleeve without their eyes glazing over because they understand that meeting is the actual fortress wall. The glamour is a rumor other people spread about your life. The reality is closer to being a permanent, unpaid marriage counselor with a CFA. And here's a specific version of this that costs families real money, not hypothetically, measurably. It's the trust funding gap. When a family sets up a dynasty trust or an irrevocable life insurance trust early, gets the paperwork drafted, feels done, and then never actually retitles the assets into it because everyone's too busy or too uncomfortable to finish the boring part. The trust sits there empty or half-funded for years. Nobody notices because the family's still wealthy, the checks still clear, the meetings still happen. It gets discovered almost always at the worst possible moment, usually 18 to 30 months after the patriarch or matriarch actually dies, when the estate goes into probate and everyone learns the vehicle built specifically to avoid this is holding almost nothing. Families lose anywhere from $2 to $9 million in unnecessary estate tax on structures that were designed, on paper, to prevent exactly that loss. The plan existed. Nobody finished funding it. That gap between drafted and funded is where fortunes actually leak out quietly for years until someone finally checks. That exact mistake, and the 4 others sitting underneath most family offices that eventually implode, is mapped out in detail in the book, discounted this week only, links in the description. If the seat sounds less like a fantasy now and more like the actual job it is, that's the point, and that's where you go next to understand it properly.